Today, we are going to discuss a case study that involves a survivorship policy. So when we look at survivorship policies, these can be great life insurance policies where both cash value and death benefit are very important to you. However, there are some items that we definitely want to be aware of because it's much different than a single life policy when we look at the MEC rules and other items as far as how the policy functions and different levers we can pull after the policy is started. So the first case study we're going to look at in this video in particular is based on a couple, both age 60, both very healthy. Likely they're going to both receive the top health rating. They recently received the top health rating with single life policies, but they have interest in a survivorship policy. The funding they're considering is $100,000 per year for 7 years. That's a total of $700,000. However, they do want the option to get a total of $1 million into the policy, and how they want to do that is just continue to fund $100K per year through year 10. So the policies are built in a manner where if they want to continue to fund the policies, they can, but they do not have to do that. And the scenarios we'll look at in this particular case study will assume stopping the funding after 7 years. Now, to hit on an item here with respect to a survivorship policy, what is it? It is one policy on two individuals. The death benefit is not paid out until both insureds die. So we've got a couple here starting a policy at the age of 60. They're both 60 years old. Let's assume the husband dies at age 80. Will the death benefit be paid out? Only the husband died at age 80, the death benefit will not be paid out. We'll assume that the wife continues to live up until the age of 90. When she passes at age 90, then the total death benefit will be paid out to the policy beneficiaries. The death benefit, again, is not paid out until both insureds die with a survivorship policy. That can be viewed as a disadvantage to some, or I should say a reason why some individuals would not pursue a survivorship policy, because if you're a married couple and something happens to one spouse and the death benefit's paid to the other, well, you've got that life insurance protection there. With a survivorship policy, again, it's both individuals. So that can be considered a drawback to some. Here's an advantage. Because the death benefit is not paid out until both individuals die, the insurance company knows that there is a high chance of them being able to hold on to the death benefit claim longer, meaning there's going to be a longer period of time before they have to pay out a death benefit claim. As a result, when you look at the insurance expenses on a survivorship policy, they're lower typically than what you'll see with a single life policy. So in short, that results in more cash value often when we compare a survivorship policy with some single life policies. Not all the time, but it is very common to see that. However, there are some very important things to be aware of, which we're going to cover in this video when we examine the different products. What we're going to look at, we're going to look at a Survivor Whole Life 100 policy. What that means is that premiums are payable up until age 100. It does not mean that the couple must pay premiums until they're 100 years old, but that's how long they can pay the premium if they want to. Then we've got a 12-pay policy. This means we can pay into it for 12 years. After 12 years, the premium is no longer due. So we have a shorter funding period in this particular case. And then we have what is called an estate guard whole life insurance policy. This is a survivorship policy where you see premiums due for a longer period of time. We'll go through the illustration as well. Policy design. So in designing a policy, we'll take the same approach we would with a single life policy, which is maximum cash value. And why we do that, even when a high death benefit is a priority, is when you look at a whole life insurance policy, single life or survivorship policy, the policy with the most cash value long-term will have the greatest death benefit long-term. Now, on the flip side, going with the highest cash value up front will often result in the lowest death benefit up front. So it is something we like to look at to see examples of, hey, do I go with a minimum death benefit up front and know if I pump that cash value up over time, my death benefit will pump up with it? Or do I go with an option that has more life insurance up front, and maybe I sacrifice some long-term performance, but then I know I have that protection? Seeing the options help. Maybe it's one product we look at with two different designs with a higher death benefit up front versus a lower death benefit up front. But in these examples, because cash value is a goal, we're going to look at a minimum base premium, which will reduce the death benefit, reduce the insurance expenses, and then we will maximize the PUA. Now, what I want to hit on here is the MEC treatment. If you were to look at a single life policy, meaning just a whole life insurance policy that's maximized for cash value, how long do we have to keep the death benefit high in order to prevent a MEC? Give you a hint. We see the number of years in this case study, 7 years. With a single life policy, what's another name for the MEC test? The 7-pay test, which represents the first 7 years on a life insurance policy. So if this case study involved a single life policy, meaning it was not a survivorship policy, let's say it was just a 10-pay policy or a whole life 100 on one individual, say the husband, what we would do is fund it at $100,000 per year for 7 years. And then what do we do at year 8 regarding the death benefit? If we have a term rider, what do we do with that? We cut it. That reduces the death benefit. We could also look at a reduced paid up option, which will eliminate the premium, and that will also do what to the death benefit? It'll reduce the death benefit, allowing me to reduce the insurance expenses, and that will often result in stronger cash value growth. That's an advantage to those options where after the 7th year, I can reduce the death benefit, lowering expenses, and maximize cash value. With a survivorship policy, you cannot quite do that. We get this question sometimes from agents too, which is why would you not use a survivorship policy? Because that can drive the cash value north much faster. And there's truth to that. The reason why is because when you look at the MEC treatment, you do not have that same 7-year test. Meaning if I design a policy with a $100,000 MEC limit, you're going to see that in some of the examples. That's my MEC limit, which is still based on the death benefit. But then at year 8, I drop the term rider, or I exercise a reduced paid up. What'll happen is I'll trigger a MEC, a modified endowment contract. What you'll find is whatever death benefit that was required to attain a $100,000 MEC limit originally, my death benefit cannot drop below that figure at any point in time. So it's not just the first 7 years I have to be aware of, it's the entire life of the policy. So when working with individuals, if a survivorship policy, or I should say if my goal is to maximize cash value and I might want to reduce that death benefit down the road, or if I'm funding with a lump sum, the survivorship policy might not be a good option. It works well if you're in a position where you've got a large amount of assets where you can continue to fund a policy, even if life happens and your income stops. If I'm relying on my income only to fund a policy, and then something happens where I can't pay into it like I thought I could be in trouble there because I can't pull levers such as reducing the term rider or reduced paid up. I'll trigger a MEC. Whereas with a single life policy, we would do that. So my point is there's some other things that we have to be aware of. And of course, we help with all of that when we're working with someone. So to look at this example, let's take a look at the different products and let's begin with this survivorship whole life 100 policy. So breakdown as to where the money is going. That's always the first question, because where can your money go? Base premium or PUAs? Base premium, term insurance, or PUAs? So here, you've got an annual outlay of $100,000 per year. Here's your base premium, just over $10,000, which is as low as we could drive it for this couple, both 60 years old. Then we've got other riders, which we can explain what all of this means. We've got videos that explain it actually. But what I want to hit on is this. He funds it here, the husband, for 7 years at $100K per year. What happens in year 8? We see this column, this annual surrender, and what you'll notice is that number, the $10,426, matches the base premium, $10,426. So when we see this column, an annual surrender here, what this is representing is the fact that you are not paying the premium. The policy is covering the premium internally. What's happening is this amount is being surrendered from dividends and also what's referred to as rider value, call it just build up in the policy, cash value build up over time. The policy's paying for itself, it's covering the premium internally, while the cash value is still growing. Really, if you just want the bottom line, here's what I'll look at. My net out of pocket is 0, and is my cash value going up? The answer is yes. Okay, good. That's what I want to know there. The death benefit over here, what happens here? Increases while I'm funding. What happens after year 7? Begins to decrease, but not by much. It always stays above 1.9. And here's an important note here. That initial death benefit's $1.8 million. 1.8 million, MEC limit, $100,000, bottom right-hand corner. So what that means is that our policy cannot have a death benefit lower than that $1.8 million, because if we reduce it to less than 1.8 million through a reduced paid up option, what will happen is we'll run into a MEC. So that's something we always have to look at. Now, it is very possible that a reduced paid up could be available 10 years from now, or 10 years after the 7-year funding period, or later down the road. That's very possible. But in this particular example, we could not execute a reduced paid up. So we just let the policy pay for itself indefinitely. When we look at the guarantees, that's not an attractive option. A reduced paid up is much more attractive there. But this is an option, and we've got a survivorship whole life 100 here with the premium due indefinitely. Let's look at that 12 pay example. So same company here. With the 12 pay, what I don't like is that premium's higher naturally. It's almost $18,000. And this is me pulling out all the works when designing the policy for maximum cash value. So it's at $17,000 and change. But with a 12 pay product, it's a limited pay policy. So what you typically see is more of that premium comes back to cash value as the years pass, particularly year 2 in this example. For the first year, you're at about $77,000 and change. Do you remember what it was in the last example? We're going to look at that soon with a side-by-side. What else do you notice here, though? Look at the death benefit. You're at $1.5 million. The last example was what? 1.8. Why the difference? Well, the 12 pay product has a guaranteed rate of 3%, whereas the whole life 100 product has a guaranteed rate of 3.75%. All it means is that a different death benefit gives me the same MEC limit. And if you view that as confusing, the main question I would ask when you're looking at a policy is, what's the MEC limit? This way you've got awareness on what that MEC limit is, and then you know the minimum death benefit needed in order to attain that MEC limit and make sure we don't run into a taxable event. So looking at this guy, numbers look good, break even between years 5 and 6, funded it for 7 years, just like the last example. But what else do we notice here? There's your funding. Annual surrender, higher surrender here because the premium is higher. But what else? It lasts for a shorter period of time, only through year 12 instead of through age 100. Here you've got the term rider. This is the other big thing I'm looking at. I do not want a term rider attached to a policy too long with a survivorship policy, or any policy for that matter. But as I grow older, I don't want that to be attached to the policy and at a high dollar amount too long. It will negatively impact the performance. So we can't drop the death benefit lower than 1.5 million. So if after the funding, I cut off the 150, I'm just about there. We could chop it off. We're very, very close. But what we did instead is just gradually reduce it and made sure the death benefit stayed well above 1.5 million, building in a little bit of a buffer in the event that dividends go down. If dividends go down, what could happen is you could see the death benefit increase at a little bit slower pace here, which could result in less death benefit here and a potential MEC. Different company. Here we go. Here's your funding, 100K per year. Net death benefit, 1.7 million. Through when? Through the end of the funding period. So how this particular design works is we've got our whole life death benefit here, our term rider over here. And as the whole life goes up, mainly as you pump money into PUAs, your term rider comes down, always keeping you level at the 1.7 million until the term is gone altogether. Like the 12 pay we just looked at, the guaranteed rate is 3%. So all I know when I'm designing this is that I need a death benefit of about 1.5 million in order to prevent a MEC. So what we could do in this particular case is execute a reduced paid up in year 11. And when we executed it, the death benefit did drop. Went from 1.7 to about 1.55, 1.56, but that's higher than 1.5. So we did not trigger a MEC. However, if we were to look at the guaranteed values, we would trigger a MEC there. That's the kind of stuff we want to look at and really make sure that we've got awareness before starting a policy. Very, very important there. But in this example, we're good, and my opinion is we would be likely fine if we followed through with the strategy and funding with a major mutual company. We should be good there. So let's look at a quick side-by-side here, beginning with the Whole Life 100 product option, which, by the way, was the initial option he looked at and what he was interested in. But then it was one of those situations where I said, hey, this is a good option, but by the way, what I might consider is perhaps options B or C, which you've got the same funding, but here we've got the same company, just a different product. And then also a different company with a different product over here with a bit more PUA flexibility with how Guardian works, but just different options, because in his position, he has discussed the cash value a couple times, where that's important to him, and maximizing that. And discussing the guaranteed values and non-guaranteed values. He likes the major mutual companies. He has some existing whole life insurance policies. He did not start them with us. This was years ago, but he does track the performance, meaning he looks at what was illustrated, then he looks at what his cash value actually appreciates to each year. This way he can see, is one company performing better than another based on what I actually have and what I actually pay in. And he has noticed a trend with different companies and such. But anyway, the trend is consistent with what we often talk about. But here we go. The Whole Life 100 breaks even when? Between 5 and 6. How about the 12 pay? Between 5 and 6. There's not much difference there, is there? In the first year there is. How about by year 6? No. You've got 611 with one and 610 with the other. There's about a $1,000 difference. If you look at year 10, is there much of a difference? Not really. When you'll see it start to pull away is after year 12. The reason why is because you still have that premium due, years 8 through 12 in this example, whereas over here, you've got it due all the way through age 100. So once that's gone here, what happens? Well, I like to explain it as there's less drag on the policy, so the cash value can pick up the pace and the death benefit will naturally do the same. So what you'll notice here as time passes, this death benefit in the Whole Life 100 is higher, but as we get close to the end in our mid 80s and 90s, you'll notice the 12 pay is stronger across the board. Look at 85, very close. You've got more cash value, close to 100 grand more. You've got about 70,000 less in death benefit, or about 60,000 less. At 90, what's happened? Stronger on both sides with the 12 pay. Again, that's the same company there, looking at the non-guarantees. Then we've got the Guardian option, which starts out with that level death benefit of 1.7. So it starts out a bit higher than the 12 pay. He also has flexibility. What I mean is he can commit to the minimum premium only. It's about $10,000 per year when you look at the premium and the term. And then he can add additional funds to the product at his discretion. So if this is you, what it means you can do is instead of being billed for $100,000 every year, you can be billed for $10,000 and then add the rest at your discretion. The other 90, you could just throw it into the policy. Very flexible there. And also, we executed that reduced paid up after year 11. So what we can look at here, some IRRs. Check that out. After year 12, see that little jump in performance, right, with that 12 pay. You'll notice it over here year 8 after the funding, and then you'll see another slight jump, year 10 to 11, when we execute that reduced paid up. Point is, really what we're looking to do here is maximize the overall value. Husband is an engineer, very, very technical individual. The wife's a physician, had a lot of questions. She's been doing a lot of research on her own. But really, when we're examining the policy, she had more high-level questions from a planning perspective, what she wanted to do, the cash value and death benefit long-term, wanted to set it up with the proper trusts and such. And then he really dove into the numbers and said, okay, in my analysis, looking at these different products, here's the option I really like, or here's what I'm gravitating toward. What can we do to tweak this a little bit, or can anything be done to tweak this? And when we do make it tweakable, what we're looking to do is typically set the policy up identical from the get-go, so you can make those tweaks and adjustments after you start a policy. This way you don't have to feel like you've got to get everything right from the get-go, because there are many changes you can make after starting. So I hope you enjoyed this video. In our next video, we will look at case study number 2, which is based on the same 60-year-old couple, but larger dollar amounts, specifically for an estate planning case. So if you did enjoy this, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.